This, folks, is the Financial Times. It's a pretty reputable newspaper for what it's worth, and we've got an article in here that we've got to talk about because it's basically talking about how Jerome Powell is wrong. In fact, it's called Powell's Inflation Bet is Based on Flawed Reasoning. Now, I saw this and I thought, let's get some coffee and read it because it's hard to read without coffee. But beyond that, yesterday I made a video about 8 reasons why the Fed might be right, why inflation might not come. And that is probably a really good video to watch before this one, to especially if you think inflation is coming. It's always good to, challenge your confirmation bias, right? Or challenge your biases. And that's exactly what I'm doing here, because this here says Powell's wrong. And so I want to see, why does this person think Powell's going to be wrong? Is it just going to be, well, he's running the money printer, or his mouth is moving, or what's the actual argument going to be? Well, I gave it a read, and I thought, you know what? This is actually something we should talk about. He's got some good points. So this author's name is Andrew Parlin, and his title, or the title of his article is Powell's Inflation Bet is Based on Flawed Reasoning. And here are just some parts of what he says. So the first thing that he starts off with is basically saying, underneath Jerome Powell's gray suit and mild manner is a man pursuing one of the highest risk policy experiments in economic history. I'm like, oh, you got me hooked with that one. You know, in 4th grade when they're like, make sure to hook your audience in, I'm like, oh, damn. Well, I don't know. I want to know. What's your reasoning? I mean, it's not that long of an article. Let's hear what it is. And so here it is. So first, he describes that Jerome Powell is somebody who believes that inflation will temporarily overshoot 2%, then fall back to 2%, and that we won't need to raise rates until 2024. He goes on to say that Jerome Powell believes we're going to have a growth rate of around 6.5% in 2021. Unemployment will go to 4.5%. Yet, all of a sudden, all of this is going to happen while at the same time we're buying $120 billion per month in Treasury bonds and mortgage-backed securities. 80 billion of Treasury bonds and 40 billion of mortgage-backed securities. And so here are the 4 reasons he gives for why Jerome Powell is going to be wrong and why inflation is going to come with a vengeance much more strongly than we anticipate, and why that's going to be devastating for markets and potentially lead to a market crash. Like, all right, man, give me your worst. Let's hear it, okay? Because I had 8 reasons yesterday. You got 4. Well, I kind of got you outnumbered here. But let's see how good the arguments are, okay? So first reason he gives. The risk-reward of his experiment is wholly asymmetrical, skewed hugely to the downside. If Powell is right, it is unclear what the reward will have been. The downside, however, is incalculable. An entrenched inflation, such as which we have not known in decades, and the need to slam on the brakes throughout aggressive retightening. Given how inflated asset prices are, the bust that would follow would probably be unusually severe and protracted. Okay, let's unpackage that because those are some large words here. Basically, he's saying, Jerome Powell thinks our economy is going to grow way slower. He's skewing to the downside. He thinks it's going to take longer, but he's not protecting against the odds of the economy actually growing way faster than we expected to. And then all of a sudden we're going to be caught with our pants down because inflation's going to go up, interest rates are still going to be 0, and we'll have to quickly adjust, raise rates, and that sudden increase in interest rates is actually going to cause a severe crash and meltdown in especially high-value stocks because all of a sudden the Fed's going to have to eat their own words and they're going to have to U-turn. So why is Jerome Powell or basically aligning his philosophy or his principles so far to the downside that no, it's going to take a while to grow. It's going to take a while for things to get back to normal. Why is he going so heavy to the downside? Why is he not going with a little bit more of a middle of the road approach to go, okay, we want to make sure that if things need more time to grow, we can accommodate that, but if things start booming, we can accommodate that too. Why is he so confident that rates aren't going to need to be able or need to go up sooner than 2024? And by not preparing for that possibility that rates might have to go up sooner, this author thinks that we are basically creating or setting up for a massive bust that would be unusually severe, so sharp and far down, big drop, and protracted, long. So a long, crappy period of time, and this could honestly, and he didn't say this, but this could spawn the great deleveraging that Ray Dalio always talks about, where people all of a sudden get burned by all this debt, and then they get super nervous about debt ever again in the future, and then they start spending less, they start paying down debt more to try to avoid bankruptcy, or they went bankrupt and they don't want to get into debt anymore, and it actually ends up slowing down our economy for many years into the future. Oh, damn. That makes me want to pay down some margin. Like, seriously, like, okay. I mean, that's not a horrible argument. Now, Jerome Powell would probably, we don't know because they won't let me interview him. I keep trying. But anyway, Jerome Powell will probably respond with something like, well, hey, look, we're monitoring this. And if inflation does go out of hand, we have tools to deal with that. But ultimately, the big priority is making sure that people who are hurt the most, like minorities or women, have enough time to be able to get on the ride, so to speak, of this economy growing. And so we don't want to raise rates too soon to prevent people from being able to get on the ride. And yeah, that might mean some asset prices go up, but that's our mission, to have full or maximum employment and stable prices. Maximum employment also includes minorities and women. At least that's how the Fed has been defining it lately. So, hey, okay, I mean, interesting point, okay? Okay, second, the level of inflation vigilance on the part of the Fed chair is a critical component in keeping inflation expectations firmly anchored. So basically, what Jerome Powell says matters. Okay, got it. An old Wall Street adage states, when the Fed chair starts to panic, investors can relax. Here, we have the reverse. And that's interesting because when the Fed panicked in March of last year, that was like the perfect signal to go buy everything in the stock market. Now, Jerome Powell is super chill. He's like, bond yield's going up, no problem. That's part of our plan. It's all good. It's all under control. It's a good point. Okay. It's no surprise that in reaction to Powell's blithe dismissal of the inflation risk, expectations of inflation have leapt to another high. So in other words, a big signal, in this author's opinion, that inflation is coming is actually how nonchalant the Fed is being about inflation. I think that argument is weaker than his first argument. I think his first argument was actually really good about, hey, we're really skewing to the downside here, not if the economy does well, which sets up the possibility of having to adjust, and that could lead to an issue. And we don't want to see a Ray Dalio great re-leveraging. Okay, third, Powell has repeatedly stated that inflation has surprised on the downside since the 2008 collapse. And this is true. Inflation has been way lower than we have expected that it would be since 2008. This is true. This is, of course, true. Oh, well, those are his words, too. But perhaps not so relevant. Economists have only recently come to appreciate to what extent fiscal policy was a drag on both growth and inflation during the last decade. And this is his reasoning here. The total pandemic spending just passed 1.9, or including this $1.9 trillion package we just passed, now exceeds $5 trillion, which means we have spent $5 trillion in the last year, which is 5 times or 5x what we spent between 2008 and 2009. Now, many economists look back and say we spent too little in 2008 and 2009, but this author is correct to say that there is no precedent. It's extremely hard to predict what's going to happen after spending $5 trillion, 5x what we did in 2008 and 2009, when there's no precedent. This has never happened before. We've never just printed 25% of our GDP. Okay, fair, no precedent, that's fair. We do have trends that suggest we are declining in terms of inflation expectations, certainly over the long run. And again, watch my video with the 8 arguments as to why we might not see inflation. I posted that yesterday. Very, very important that you watch that one if you have not yet, and you're watching this one. And you can make a more thorough opinion that way too, yourself. Because to me, your inflation expectations dictate how you invest as well. Okay, so it's a fair point. Okay, we have not spent this much money before. This is unprecedented. hopefully, we'll actually start getting some more data to help us understand better how the economy is responding to what's going on. Is the velocity of money going to go up again? Are we going to see inflation on a month-to-month basis start skyrocketing? Are we actually going to see prices going up? We've certainly seen prices like commodity prices like copper and lumber go up through the roof. Are those going to persist? Are those high prices going to stay? Or are they going to be temporary? A lot of questions to ask. Okay, so far I really like that first argument he made. The second one, this no precedent one, it's a good argument. It's true. What he's saying is true. There has been no precedent. Now, fourth and finally, Powell should be especially distrustful of himself and his own judgments, for he has firsthand experience in applying the wrong policy prescription. I don't know why they have to write in tongue, maybe because this is the Financial Times and they want to be fancy, but basically what he's saying is, your boy Jerome Powell's been wrong before. Just look at 2018, okay? 2018, he's like, oh, no, we're going to do automated interest rate increases. And he crashed the freaking market and then had to U-turn on what he was doing and lower rates again because he screwed up. He made a big mistake. And you can actually go through my YouTube channel and see me covering this stuff in 2018, which is crazy. Now I'm starting to feel old that I covered that. I mean, that's only 2018. So, 3 years ago, 2.5, 3 years ago. But I remember those days. I'm like, oh, God, what's Jerome Powell going to say? And this was back in 2018. It's just the same thing. Good point. Okay, touche. Jerome has been wrong before. Touche. And he hasn't been, chair for that long. So anyway, this author ends with, the point is not to rub the 2018 policy error in Powell's face. Misreadings of the economy are routine, which circles back to my main point. With so little known about the dynamics of consumer price changes, there is no need for the Fed to make multi-year promises to hold rates at zero. It's time to start the conversation about monetary tightening. Mic drop. Andrew Parlin is founder and chief investment officer of Washington Peak Investment Advisors. I mean, this is not a bad article. Not bad at all. I don't, like... I guess my conclusion from this article is, A, yes, it's true, Powell's been wrong before. Yes, it's true, there has been no precedent before. I think the argument about, what was his second argument? His argument about, do the opposite of how the Fed feels. I think that's a little, bit more anecdotal, right? And plural of anecdote is not data. So that's important to consider. So he's got good points. I don't think those points outweigh the 8 arguments that were made on why we won't see inflation yesterday. Watch that video. I'll link it down in the description below, right at the top. Just hit the little expand and you'll see it there. I might even pin a comment with it. The big one that is interesting to me, though, is his first argument about if Jerome Powell is wrong, we could see a pronounced and prolonged, unusually severe and protracted crash, basically. And that reminds me of the Ray Dalio Great Deleveraging, and it's a good reminder for me to go, Kevin, margin. Pay off the frickin' margin. Right now, and prices have gone down, have gone up a bit, but I've also been paying off margin. I am at about 28% margin, which is good, but I do want to see that plummet. I want to get that down substantially. So we'll see what happens. But yeah, that is a very good article. Appreciate this. Let me know if you found this helpful or insightful. Kind of scary a little bit too. Anyway, let me know what you think. Folks, we'll see you in the next video. Thanks so much. Bye.